$3 trillion. That's how much money is now sitting in private credit, loans made outside the traditional banking system, to companies most people have never heard of, valued by methods almost no one understands. And this is what makes it personal. A significant chunk of that $3 trillion belongs to pension funds. Teachers, firefighters, state employees, police officers. Nearly $500 billion from the top 20 public pensions alone. Money that's supposed to be there when these workers retire. The people whose futures depend on these investments have no idea what's actually inside them. They can't see it, they can't exit. They're trusting a system that's designed at every level to obscure rather than reveal. If you're one of these people, if your retirement is tied to a public pension, this is about you. Even if you've never heard the term private credit before this moment. That's the story I want to tell you today. Not whether private credit is good or bad, but what happens when we build retirement security for millions of people on top of something we can't see into. I started pulling on this thread last fall. I have this thing where I end up in conversations most people would find unbearably tedious. Documentation trends, contract language, the fine print that never makes headlines. I find it fascinating because that's usually where the truth is hiding, in the details nobody thinks to examine. So, I was on a call with a credit analyst. We were deep in the woods on covenant structures. Fun, right? And she mentioned something almost in passing. She said, "We're seeing J.Crew blockers in almost everything now." I asked her, "What is that?" There was this pause. Her voice shifted. She said, "It means the lenders don't trust their own borrowers anymore." Not really. They're building walls into the contracts because they're afraid of what happens if things go bad. I felt that familiar sensation, the one where a small detail suddenly feels like it's attached to something much larger, like tugging on a loose thread and realizing it's attached to the whole garment. 45%. That's the number I found when I started digging. 45% of private credit deals in the third quarter of 2025 now include these clauses. So they're named after a move the clothing retailer pulled a few years back. J.Crew shifted valuable assets away from lenders right before things went south. It was aggressive, controversial, the kind of thing that makes creditors feel played. And now nearly half of all new deals include language specifically designed to prevent that exact maneuver, up from 26% a year earlier, up from 15% at the start of 2023. And I kept coming back to what she said. Lenders don't trust their own borrowers. These are people whose entire job is to assess risk, to know who's safe to lend to, and they're so worried about the companies they're choosing to fund that they're building walls into almost every contract. So if everything is fine, why is everyone so afraid? Welcome back to Interconnected. That question stayed with me. Lenders don't trust their own borrowers. It became one of those thoughts I didn't want to put down, the kind that comes up while you're doing something else, washing dishes, half asleep, walking to get coffee. I kept circling back to it, trying to make it fit with everything else I thought I knew. And the more I looked into it, the more I found this strange disconnect. The official story about private credit is that it's doing well. Default rates are stable. The industry is thriving. $3 trillion globally now, up from $200 billion 15 years ago, a success story. But then you look at the behavior, and the behavior doesn't match the story. Lenders are quietly preparing for distress. One analyst put it this way: lenders are anxious about the future, and that anxiety is showing up in the terms they're demanding. So how do we reconcile that? Either they know something the numbers don't show, or the numbers themselves are hiding something. That gap between what the data says and how people behave is the kind of thing I don't want to leave alone. Maybe you know that feeling. When something doesn't add up and everyone around you seems fine with it. and you can't tell if you're seeing something real or being paranoid. That's the friction I didn't want to leave alone. Not whether private credit is good or bad. The question that hooked me was this: what is this market preparing for that it isn't saying out loud? So I started with the obvious place, the data. Private credit, for those who haven't encountered the term, is basically lending that happens outside the traditional banking system. Instead of getting a loan from a bank, a company borrows from a private fund. These funds are run by asset managers backed by institutional investors. And unlike bank loans or publicly traded bonds, these deals are private. They're not traded on exchanges. They're not rated by the major credit agencies. They're negotiated directly between the lender and the borrower, often with terms that never become public. The market has exploded. We're talking about an industry that now rivals traditional banking in scale. And when I looked at the numbers, well, they seem fine. The Proskauer Private Credit Default Index showed a default rate of 1.84% in the third quarter of 2025, basically flat from the quarter before, significantly below the default rates in the broadly syndicated loan market where loans are traded publicly. So, on paper, private credit looks solid, better than solid, safer than the alternatives. But then I started reading more carefully, and I kept running into this phrase, performing status. A loan is either performing, meaning the borrower is current on payments, or it's not. Simple binary. Except one analysis stopped me cold. It argued that in many cases, a loan's performing status reflects leniency rather than actual credit health. I had to think that through. The default rate only captures what gets called a default. No kidding. But there are ways to avoid that label, ways to keep a struggling borrower technically current while the actual situation deteriorates. So I talked to someone who operates inside this world. I'll call him David. He's a composite character synthesized from conversations with people who worked in private credit portfolio management. I told David what I was seeing. These headline numbers look fine, so why are lenders acting so scared? Help me understand what I'm missing here. He gave me a look. He said, "You're looking at the scoreboard. You need to look at the game." He explained something called PIK, payment in kind, and here's how it works. A borrower is supposed to pay interest every quarter, but they can't. They don't have the cash. In a traditional loan, that might trigger a default. But in private credit, there's often a provision that lets the lender say something different. Instead of paying us cash, we'll just add the interest you owe to your loan balance. You now owe us more principal. On paper, you're current. You never missed the payment. But the debt is growing. And David said something I wasn't expecting. He said, "We call it a bad PIK when it gets added after the original deal was signed. That means something went wrong. The borrower hit a wall they didn't see coming, and instead of calling it what it is, we paper over it." Naturally, I asked him, how common is that? He told me in the third quarter of 2025, more than half of all PIK arrangements in private credit were bad PIKs. Added after the fact, not part of the original term, more than half. Let that sit for a second. More than half of these arrangements are essentially a sign that something went wrong. A borrower could not pay, and instead of calling it a problem, everyone agreed it was fine. So I asked the obvious question. If more than half of these arrangements are essentially a sign that something went wrong, why isn't that showing up in the default data? And here's how David put it. Because it's not a default, technically. The borrower is current. The loan is performing. Ask me if I'm going to get my money back. That's a different question. But for reporting purposes, everything looks fine. The data wasn't lying, but it wasn't telling the whole truth either. So if the data is designed to obscure rather than reveal, then who actually knows what's happening? And more importantly, who is exposed if things go wrong? Private credit funds don't materialize money. They raise it from investors. And the largest investors I discovered aren't hedge funds or wealthy speculators. They're pension funds, insurance companies, endowments, sovereign wealth funds. I found a Federal Reserve analysis showing that public and private pension funds held about 31% of aggregate private credit funds assets, roughly $307 billion. The top 20 U.S. pension funds alone hold close to $500 billion in private market exposure. Some have doubled their allocations over the past decade, and that raised an alarm in me. I understood the exposure was real. Teachers, firefighters, state employees, their retirements were tied to these loans. But what I couldn't understand was the decision making. Pension funds have fiduciary duties. They have boards, professional managers, and risk committees. They're supposed to be the adults in the room. So why would they pour money into something this opaque? I talked to someone who would help me understand. Let's call her Margaret. She's a composite character, drawn from conversations with people who have worked in institutional investment and credit risk analysis. I laid out what I was seeing. All this opacity, all this sudden stress in the loans. Why would a pension fund touch this? She didn't get defensive. She sighed and said, "Do you know what an assumed rate of return is?" I told her, "Yeah, I have a rough sense. It's the rate a pension fund assumes it will earn on investments to meet future obligations." She nodded, "Yeah. Most public pension funds assume somewhere between 6 and 7% annually. That's the number that makes the math work. The math that says we'll have enough money to pay retirees what we've promised. The problem is safe assets don't return 6%. Treasuries, maybe 4 in a good year. So we have a gap, and that gap is existential. If we don't close it, we can't pay benefits. Politicians don't want to raise contributions. Nobody wants to cut benefits. So we reach." I asked her then, what does reaching look like? Private credit, private equity, real estate funds, anything that promises yield. And private credit is attractive because it offers consistent returns, low volatility on paper. It helps us hit our targets without the wild swings you get in public markets. So, okay, I started to see it. The reaching wasn't exactly reckless. It was desperate. They were solving a problem that had no good solutions. But then she added something that changed how I understood the whole structure. She said, the thing nobody talks about is the capital calls. Of course, I asked her to explain. So, when you invest in a private credit fund, you commit capital up front, but you don't hand over all the money immediately. The fund calls it as they need it. When they find deals to do, you're obligated to meet those calls when they come. She paused. The problem is fund managers have the contractual right to call your capital at any point, and sometimes they call it at exactly the wrong moment. She described a particular scenario. Markets are falling. Your public equity portfolio is down 30%. And suddenly you get a capital call from your private credit fund. They need the money. But you're strapped. So what do? You sell something at the worst possible time to meet an obligation you can't defer. And then she said something that made me see the whole structure with more clarity. We're tethered to private credit. In a crisis, our hands are tied in ways that aren't visible until everything is already going wrong. So I asked her, what does that mean for the people whose money she was managing? The teachers, the firefighters? She was quiet for a moment, and then she said, it means their retirement security depends on loans they've never heard of, made to companies they can't name, valued by methods they don't understand, held by funds they can't exit. And when I try to explain this to board members, their eyes glaze over. It's too abstract, too technical. So we keep doing what we're doing because the alternative is admitting we can't actually meet our promises, and nobody wants to say that aloud. Now, I had 2 layers of hidden fragility now. First, the loans themselves. Companies that look current but are slowly sinking under the weight of accumulated interest. Second, the investors. Pension funds that look stable but are tethered to obligations that can force them to sell at the worst time. But there was a third layer I hadn't fully considered: the funds themselves. The private credit managers sitting between borrowers and investors. I needed to understand how they navigate this, how they report performance, how they value assets that don't trade on any market. So I talked to someone who could help me. I'll call him James, a composite character, drawn from conversations with people who have worked in private credit, fund operations, valuation, and financial regulation. I started describing what I was seeing: all the problems with opacity, the hidden stress in loans, the pension funds locked into commitments they cannot escape. And as I was talking, I could hear myself understanding it better. That happens sometimes. I don't fully know what I think until I try to explain it to someone. I said something like, "It seems like everyone in this chain has an incentive to make things look better than they are." He interrupted me. "No, that's not quite right. It's more subtle than that. Nobody's lying. But everybody's choosing around defensible assumptions. And when you're choosing among defensible assumptions, you tend to choose the ones that make your life easier." That distinction mattered. I've been thinking about this as deception. He was describing something more mundane and more pervasive. He walked me through how private credit funds value their holdings. Unlike public markets, where prices are determined by trading, private loans have no market price. They have to be estimated. Fair value, they call it. And determining fair value involves a judgment, lots of it. You look at comparable deals, he said. You run models. You consider what you'd get if you sold today. But here's the thing. If your borrower is struggling but not in default, you have room. You can say, "This is a temporary setback. The company will recover. The fair value hasn't changed much." Or you can say, "This is a sign of deeper trouble. We should mark it down." He shrugged. Both positions are defensible, both are within the rules, but one keeps your fund's returns looking steady, the other one creates a loss you have to explain to investors. Of course, I asked him, "So what do most managers do?" He sat quiet for a moment, and then he said, "Well, what would you do? Your bonus depends on steady returns. If your investors chose you because you promised lower volatility than public markets, if marking down one loan means questioning all the others." I didn't need to answer. We both knew. He helped me name what I'd been sensing but couldn't quite articulate. He said the valuation process isn't corrupt, it's discretionary. And discretion, exercised consistently in one direction, has the same effect as corruption, but with more plausible deniability. There was a pattern. At every level: borrower, lender, fund manager, investor, the incentives point the same way: defer, obscure, smooth. Nobody wants to be the one who names the problem, because naming the problem makes the problem real. Once I started seeing it this way, I couldn't unsee it. I had been thinking about private credit as a market, a place where lending happens, but that framing was wrong. It's not a market, it's a system, a deeply interconnected system where opacity isn't a bug, it's a feature. Let me trace the connections. Companies borrow from private credit funds because they can't access traditional bank loans or public debt markets, because they're too leveraged, too risky, too small. They need the money, and private credit is the only door that's open. Private credit funds lend to these companies because they can charge higher interest rates, 9, 10, 11%, sometimes more. That's how they generate the returns they're promised to investors. And those investors? Pension funds, insurers, endowments. They pour money into private credit because they're desperate for yield. Their obligations are fixed, their return assumptions are baked in, they need income. And the whole edifice depends on one thing: the loans have to perform, or at least they have to appear to perform. Because the moment they don't, the entire chain unravels. Borrowers default, fund returns collapse, pension funds face shortfalls, retirees get nervous, politicians get involved. So everyone has an incentive to keep the appearance intact. at least as long as possible. Margaret helped me see this clearly. She'd drawn from research on credit analysis and risk management. She said, the opacity is what makes the industry work in the short term. It's what lets everyone pretend that 8% returns with low volatility is a thing that actually exists in the natural world. But in the long term, that opacity is what makes the industry fragile because no one really knows what anything is worth. And when no one knows, everyone's acting on faith. So she looked at me and said, and faith works until it doesn't. So I asked her, of course, what happens when faith breaks? She responded, you don't get a slow correction, you get a stampede. Everyone realizes at the same time that they don't know what their assets are worth. And we don't know what something is worth, you assume the worst, you try to sell. She looked discouraged. She shook her head. But there's no market. These aren't liquid assets. You can't list them on an exchange. So you're stuck, holding something nobody wants, watching its reported value finally collapse to match reality. Think about what that means in practice. A pension fund that was reporting steady 8% return suddenly has to tell beneficiaries that those returns were partly fictional, that the assets backing their retirements are worth less than anyone claimed, that the promises made to them were based on valuations that nobody could verify. The system isn't broken. It's working exactly as designed. That's what makes it so troubling. So after all this, here's what shifted for me. I started this investigation asking whether private credit is risky. You know what? That's the wrong question. Of course it's risky. All lending is risky. That's not the insight. The real question is about visibility, about who can see what's happening and who can't. In public markets, risk is priced in real time. If a company is struggling, its stock falls, its bond prices drop. The information is visible. Investors can make informed decisions. In private credit, that feedback loop does not exist. The information is locked inside the system, visible only to those on the inside, and even they don't fully see it because the incentives discourage looking too hard. James put it this way: the question isn't whether private credit is dangerous. The question is whether our financial system can withstand $3 trillion of assets that nobody can accurately price. And the answer is we don't know. We've never tested it at this scale. That statement felt fundamental. From asking, is this risky, to asking, what happens when we can't see? Because the implications are dire and different. If you're a teacher in California or a firefighter in Ohio, you probably don't know that your retirement is partially invested in loans to companies you've never heard of, valued by methods you certainly don't understand, overseen by regulators who lack the authority to really look inside. And maybe you're listening to this right now and realizing that for the first time, that this applies to you, that your pension fund might be a part of this. I wish I could tell you exactly what to do with that information, but I can't. But I think knowing matters, even when knowing is uncomfortable. The question isn't whether to be worried, it's whether you have enough information to even know if worry is warranted. And right now, the answer is no. You're flying blind. We all are. So I started with a phrase that stuck with me. Lenders don't trust their own borrowers anymore. And a number, 45%. Nearly half of all new deals now include clauses designed to protect lenders from the very companies they're choosing to fund. That's the friction. That's what doesn't fit. We're building retirement security for millions on top of something we can't clearly see. And we've done it deliberately because seeing clearly would make the whole thing harder to maintain. There's a teacher somewhere grading papers tonight who has no idea that her pension is partially invested in loans to struggling companies, restructured to avoid the word default, valued by people with every incentive to be optimistic, held by funds she can't exit. Maybe you know her. Maybe you are her. She trusts the system. She has to. She doesn't have the information to do anything else. That's what opacity means in practice. Not conspiracy, not fraud, a structure where the people bearing the risk are the last to know. Until next time, keep asking what's beneath the surface, keep noticing the patterns.